Good afternoon, everyone, and welcome to episode 96 on why profits are not enough, fixing MSME cash flow. We are honored to have CA Gaayathri Iyeer as a accomplished finance professional with over 25 years of experience guiding businesses in financial strategy, cash flow management, and corporate structuring with us again. And we're thrilled to have her with us. She is currently the co-managing partner at Susri Advisors LLP, where she provides virtual CFO services, financial consulting, and entrepreneur coaching to help MSMEs navigate financial complexities. Gayathri's expertise spans accounting, tax assessments, risk management, and corporate finance. She has also worked with some of the biggest names in the industry, including SAIL, Bokaro Steel Plant, Ispat Industries, Dolby, and Sahara Petrochemical, Saudi Arabia. As a chartered accountant since 1996, she has dedicated her career to helping businesses streamline their cash flow, improve profitability, and make informed financial decisions. She's also a passionate coach mentoring entrepreneurs on financial discipline and strategies. Today, she will bridge the gap between growth and liquidity, helping business owners get insights on financial readiness. Please join me in welcoming CA Gaayathri Iyeer. Good afternoon, ma'am. Pleased to have you today with us.
Thank you so much. That was a real thank you for introducing me with all such kind of great words. Thank you so much, Amrita. It's a pleasure talking to all of you.
So, ma'am, my first question to you for today's session is, what are the most common misconceptions that MSME owners have about cash flow versus profitability?
Yeah, this is the most common thing actually. Most of the MSME owners think that if I have made profits, that means like I am selling 100 rupees worth product at 150 rupees. That means 50 rupees is my profit. And I have that profitability inside my bank account. And that is exactly what it doesn't happen, that 50 rupees is never in my bank account. And I don't know where I have gone wrong, because most of the time I think I'm a very profitable business. But unfortunately, my bank account shows some very, very negative money which is there inside the bank. And that's where the surprise and the, the reality strikes to those people, that profitability does not mean cash flow. Cash flow is your cyclical money payments, receipt and payments again, which keeps on going as a circle. We call it as a working capital circle. So the money in my bank account will mostly be if you are effectively using your payment cycle and the receipt cycle. So that is where the MSMEs will have to get themselves accustomed to saying that the money in the bank is with my working capital. And my profitability is only a statement which is there in the P&L account.
Ma'am, can you walk us through an example where a growing business still ran into cash flow trouble?
There are so many examples which we can quote. Now, let me say from my own personal clientele, without naming him, there was one organization which was actually making a huge amount of turnover, like around 50-60 crores was their annual turnover. And their balance sheets were also looking very well. Profitability was, EBITDA was somewhere around 8 to 10% and good amount of profitability as per the balance sheet is concerned. But if suppose you become a vendor of that company, okay, the payments which you receive, they will say that they will give you 30 days ka credit, but they are unfortunately not able to pay you within 45 days also. Like they try to stretch it. Now, this is the classic example of my customer or probably some other company. I mean, I'm just randomly giving these examples, but unfortunately what happens that they are not able to maintain their payment cycle. And that is where the reality strikes, is that they are not able to manage their money and they are only posing profitability in their books of accounts. So that is the reason where I could say that these companies are not able to manage their cash flows. Now, what is exactly they do and they don't know how to manage their cash flows is, there are two aspects to a cash flow. One is the receipt side, another is the payment side. Now, from the receipt side, we have one of the major items from where you get the money is your collection from your customers, that is your debtors. And from the payment side, the major important aspect is your payments to your vendors and your people who are supplying goods to you or maybe providing services to you, your employees. So that is your major cost which comes as a payment to you. So when you're not able to balance these two aspects, like you're not able to collect money from your customers and not able to pay to your vendors, that's where the cash flow glitch starts. So most of the companies where they don't have the proper cycle which is maintained, though they may have the potential to collect the money. So I might have a lot of debtors, like I might be doing a turnover of 5 crores in 1 month. But unfortunately, I don't have a mechanism to collect that 5 crores in the next 30 days. How do I collect that money? I need to have a mechanism. I need to have a follow-up. I need to send them the invoices, collect their information, give them the GST credit. A lot of things have to be done on the automated basis, and then you need to collect that money. Now, when I'm having a system to collect the money, I also have a system to make the payment to my vendors. That also should be systematic. Like I collect all the information, like I am providing information to my customers to make payment to me. I also should have a process to collect information from my vendors and then make the payment to them. So that cycle has to be understood. Now, once I understand this cycle, I know that there can be a gap that I am collecting 5 crores, but my liability or my vendor payment in a month is 6 crores. Then there is a gap in my working capital. So I need to know how to fill this gap. And that's where the challenges start. Like people look for bank loans, people look for term loans to be taken where the money should not be used in the cash flow, but then they are using it. The gap needs to be identified well before, and the gap also needs to be filled up with requisite amount of debt. That is where the game of managing the money would be for the business owner. And I've seen most of the corporates are not having this clarity to budget it and then have the gap filled up. They always bank on that gap, and they obviously try and push the payment to the vendors and are unable to collect the money from my customers. So that is where the gap keeps on increasing and they are not able to manage the payments.
Understood. Ma'am, also for the sake of our attendees, can you also tell us how should cash flow be forecasted differently for a product-based business versus a service-led MSME?
Okay. So product-based, the entire cash flow comes from purchasing the raw material and probably having your labor expenses and your overheads, whatever you're incurring in the factory, and then obviously selling those items after you've manufactured. So this is the typical cycle for a product manufacturing. So the cash flow estimation has to be revolving around what is the material requirement in the next month. So that is the reason why we will have, and obviously what are the payment terms to those vendors, whether I'm going to pay them 30 days after or 45 days after, what is my credit terms with them. So that will determine my cash flow accordingly. The second thing is my labor payments, which is going to be on a monthly basis. Probably every month, 15th, I'm supposed to pay them, or maybe 5th, I'm supposed to pay them. Now, as per the new labor law, I'm supposed to pay them bang on before the 5th of every month. So there has been introduced penalties and all those things also now. So I need to determine what is the day on which I'm supposed to make the payment to my vendors. Then my employees, And then probably for the vendors, what is my payment terms with them? So I need to make an estimation table which will revolve around material, the labor expenses, and my overheads, which is going to be based on the manufacturing of my company. Like, for example, the electricity will depend upon how much power I'm going to use. There would be some additional material which will be required for me to use. There might be the maintenance of my machinery which is required. So all these estimations, once I do, I will be able to create a budgeted cash flow for my product manufacturing. Now, for the service thing, it is entirely a different ball game altogether. Now, for service, there is no clear-cut actual cost which will come. You will have the labor cost, that is the people who are going to be conducting those services. That will be my major cost. That's the labor cost which we talk about. There is no material here, but there might be certain other overheads which will include majorly traveling in case I'm doing some service thing and I'm supposed to reach to various places. That traveling might be added to that. So the major cost is my staff cost and my traveling, and which will add on with conveyance or maybe some staff welfare or something additional there, and which will be a small portion. But the major portion is going to be my staff cost. So my staff cost and vis-a-vis to my revenue generation. Like day before yesterday, I was talking to one of the people for providing services. So I said your man-day cost is the main key for you to understand how much the revenue you are generating and how much profitability or margins you are keeping. So these are the two major areas where you need to focus in case you are making a cash flow for a service-oriented. Labor and your traveling cost, and maybe you can also see how much is your own cost, because you also will be involved in providing services. So your own cost also you may have to factor in to determine what is going to be the cash flows. Like you as an entrepreneur or an owner, you are supposed to travel to various places, or you are supposed to buy something to get educated to give that delivery of services. So all that will be forming a part of your cash flow estimation, and that will help you in rolling your working capital. That will be helpful to you.
Ma'am, also tell us what warning signs often go unnoticed before a cash crunch actually hits an organization.
Yes, the major signal is when a cash crunch is going to hit you, is that you delay on making payments of your electricity bill. Number one, that means you don't have money to pay your electricity bill. You don't have money to pay your credit card bills. You don't have probably money to pay your laborers. That is, मतलब salary आपका jump up हो रहा है. 5 तारीख को आपने पेमेंट करना है, लेकिन आप 15 तक you are not in a position to make the payment. So these are warning signals that you are really going to go rather bankrupt. Like you are trying to manage it, but somehow you are not able to manage it, is a warning signal. And immediately there has to be you are in ICU. That is what it means at that point in time, and you really need immediate medical attention. So you really need immediate attention to take care. You need to sit onto the drawing board and find out where things are going wrong immediately. Because the moment you are stepping up all these kind of deadlines, it is a warning sign.
Ma'am, also could you share a real case where improving cash flow changed the trajectory of a business?
Okay, another classic example of my client. Okay, now let me give you his experience, like where he had an experience of purchasing certain materials from his vendors on credit. Okay, so credit kept on piling up and he's not been in a position to make the payment. And one day, that one creditor who had kept on piling up went and filed a case in NCLT, and unfortunately the company was declared bankrupt. Vis-a-vis to them going and operating as a company with a cash purchases, right? So if somebody is able to not work on credit but work on cash, the lot of obviously they have a lot of cash in their hands, so the cash flows are really good. Now, what is the benefit which he really got was a major discount in whatever he's purchasing. So what happens is that if I'm taking the material on credit, the pricing is X. But when I'm purchasing it in cash, the pricing is Y, which is Y is more beneficial to me rather than X. So there is a lot of cost saving which happens. Obviously, it means that my margins are increasing. That's number two. Second is that where people have got a good trajectory of cash which is coming and going, they're able to probably invest in a lot of things where they can market themselves and get a lot of deals which can be finished faster. So no debt, no cash flow crunches happen to them, and they are able to deliver the projects to their customers well within time, because they are able to command a price in the market because they are cash rich. So the command is there. They are able to get clients also because of the command, and therefore and the timelines in which they are supposed to deliver their goods is also reduced because you are able to pay it better. Like if suppose you create that kind of a trajectory in the market that this fellow is a very good person in paying immediately. They don't matter that it is with margins or without margins. If you are able to pay immediately, like आज मैंने तुम्हारे से car transport, I have done a transport from you, and you pay the next day or the third day. My my fees or my transport charges. So I will be very happy to do the next transaction with you, because ye baba isse follow up karna nahi padta. I don't have to really break my head to collect the money from him. He's very good in making the payment. So that improves my vendor accessibility and getting a good price. So cash in hand is always better for business, and I've seen that company growing from maybe 5 crores to 50 crores today with this trajectory of cash. So how they manage is basically taking a 50% advance from their customers, saying that, okay, I will provide you these services, but please give me 50% in advance. So once that 50% money comes, they are able to manage their entire expenses, and then balance 50% they are collecting after delivery. So that is how they have been able to manage their business well, and they've also been able to command a good price in the market.
Ma'am, you mentioned about some warning signs which revolved around, making payments to the vendors or salaries to the employees. But we've seen businesses with steady revenue still struggle with this. Why, according to you, does that happen?
Okay, now with the steady revenue and with also having a very good collection team, there could be two reasons. One is that the money which is coming into the business is being siphoned away for some personal use. If that is one of the reasons, because many a times business owners don't realize that they are taking away their business money into doing some personal things. Like, for example, one of my clients, he had a very good rolling of money, but unfortunately was very, a fan of buying cars. So, so he used to take it on loan, but the down payment used to go from my cash flows. So the one payment doesn't mean that ki wo entirely mera cash flow ko standstill pe leke aayega. Not like that. It's not that a singular transaction is going to impact, but regularly doing that kind of transaction will impact my cash flows. So that is where we have to be mindful that whether I am using my business money for my personal purposes. I am not supposed to do that. And especially if I have to buy something, I might have to take complete loan, and maybe a down payment can be from my salary, which I am taking to home. So it cannot be that I'm using a lot of my personal expenditure through the business. If the business is going to have that car, then it is fine. It's for the business, so it will probably generate revenue by you being able to travel to various places so that you can generate a lot of revenue. So you need to always see the return on investment for what money you're investing and what is the result it is going to bring for the business. That is very important, and most of the times business owners are unable to differentiate their personal and their professional expenses. And this happens in case you are going to have a proprietary concern, because bank account bhi same hai. So they don't have a different current account, banate nahi hai. They don't have differentiation between personal and the professional expenditure, and that's where the problem starts. Now, the second very important thing is that once I am having a good amount of profit in my profit and loss account, assuming, I am very complacent. I just get laid back and saying that, oh, I have earned so much. But unfortunately, the earnings are lying in my debtors' books. It is just a book entry which is showing my profitability. So I should have a robust team to collect money. I know I'm doing a good business, but collection should be also that robust that I don't have any outstandings more than 30 days with me. The moment I have these kind of collection mechanism which goes for a toss, then I have more than 180 days people have not paid. I've got more than 1 year I have not paid. And many a times what happens is that there might be a lot of disputes with my customers. I don't know what happens, that most of the business owners don't want conflicts to be addressed. They want the conflicts to be laid down. Okay, let me do it later on. But later on, what will happen is that the money lying in his hands, if not resolved, will become a huge liability. And that will actually bring to my entire vehicle to a grinding halt. Now, this has happened with me as well. Like when I am having a lot of businesses done with various customers. Now they say, "Oh no, I don't like your services. I will not pay you so much." Now, as a team, I don't resolve it. Okay, fine. You felt that I have only performed to the 50% of my abilities. Pay me 50%. Resolve it. No, I don't. I want the 100. He's not ready to pay the 100. But he's ready to pay. He's not even ready to pay 50. He's ready from 100 to 0. He has come. So I have not negotiated and got at least that 50 out. So I am keeping that in slumber. And what happens is that one day that fellow goes away. Any which ways, he doesn't pay me that 100, no doubt. He's not no more my customer. And I have lost my money there entirely. And the effort which goes to collect that money is also lost. So I am not addressing the elephant inside the room. I am not trying to address the right issue inside the room, and I am unfortunately burning my fingers there. So this is also one of the reasons why business owners do not know where their cash flow is sitting and how to resolve it. We don't want to address conflicts. That is the unfortunate problem with us. As a human being, we feel, oh, let's not fight. Let's not give a peace of mind to somebody or get that peace of mind from somebody. Want to avoid it. And that's where I'm criminally doing a wrong thing. I need to address the issue then and there and resolve it and have a situation where whether he accepts or I accept and we close it. We don't do that. So I mean, according to me, at least, I think these are the two major reasons where the company is doing really great, but unfortunately does not have a cash flow.
And ma'am, now according to you, what role does inventory mismanagement play in disrupting the cash flow?
Fantastic. The inventory is a very pricey, मतलब जो word use करते हैं, people use it as a mal or a material. So that actually creates a lot of, there are a lot of studies also which has come on that basis, like just in time, or there is a lot of inventory management techniques which are there, where we use it like where the reorder level, and then you have the minimum level, maximum level. So you really need to address that issue while understanding and doing the business, because it's a key investment in the business. If I am not able to do that, what I will have is that I will have a lot of finished goods which are obsolete, but I still keep them in my inventory. They are not going to generate a lot of revenue. Now, this happens in companies where there is a lot of volatility in the customer preferences. So like, for example, if I'm dealing with an FMCG product, like I'm talking about, let's take an example, Colgate. Okay. Now, Colgate makes a lot of different bases toothpaste. Like it's a gel-based toothpaste, or it's a powder-based toothpaste, or it is a white cream-based toothpaste. So depending upon the customer preferences, locational customer preferences, I need to understand that how much I'm supposed to manufacture so that they can be delivered to those respective locations, right? Now, if I know that in one particular, all the three things, there is something which is coming as an against thing for powders. Let's take an example. For powders are not being preferred by my customers. So now you see that the powders are not to be manufactured. Now, how do I dispose of what I have already manufactured? Am I going to hold it and say, okay, the market price is saying it's 50 rupees, so I'm going to sell it only at 50 rupees? Or is it that I'm going to say that this material is now not being sold in the market, let me just give it away at a discount of maybe 50% or 30%, whatever is a discount, let me just dispose it off and make that inventory into cash. So these kind of very strategical decisions have to be taken when it comes to inventory. So I cannot be sentimental. I have to be practical at this point in time. I have to understand that the market is not buying my powder. That dental powder is not selling as of now. So what am I supposed to do? Am I supposed to sit and crib about it? No. I'm supposed to take an action about it. Now, if that is not selling, let me bring up in another refined version of a powder, probably to try out the market, but at least the old one has to be disposed of. There might be people who are in a strata that they can buy goods on a percentage because they are more on value money based and they don't have any preferences as such. Cleaning the teeth is a basic preference, so they don't want to say I don't want this powder and I don't want that powder. They are not in that bracket of income where they can have their choices, but they need it as a necessity. So we can give that to them at a 30% discount or a 50% discount and remove that inventory from your kitty. And that makes it very different and very rather a mindful decision to be taken by business owners. This is where you have to be proactive and not reactive. So that's where I understand that inventory is going to be the major cost in any organization, and it is really important for them to understand how to maneuver it and hold the goods only which are going to sell and not them which are not going to sell. Similarly, from the inventory, that is the raw material perspective, also they need to know how much they need to buy and how much they can hold on. So there are certain formulas which help you to understand the actual amount which should be purchased. So they must utilize all those techniques which is available in the market so that their limited investment is going in the inventory.
Got it. Ma'am, now moving on, how can small manufacturing units build a disciplined cash flow cycle, especially with delayed receivables?
So the first discipline which I understand with a business owner is that he should keep his personal and business separate. That is the first discipline I would expect any business owner to do that. Second very important thing is that he need to have a proper budget. For all the expenses on a monthly basis, he need to have a budget, and then obviously he needs to monitor that budget and see to it that he is able to execute them based on his collections. Now that's where the second estimation comes, is on his collections. Like as you rightly said, that there are a lot of delayed receipts. So the first thing which any business owner must do in case of delayed is to see that how they can be supported in the working capital. Go in for a cash credit facility from a bank, or take help from these kind of institutions or bankers who can help you to bridge the gap between your cash flow, outflow and inflow. Where there is a delayed collection in your business, like in your category of business, there is a lot of delayed collections. So many of the business owners, when they take the cash credits, they see to it that their debtors of 180 days are being funded, not 90 days, which usually the bankers say, "Ki main 90 days ka hi funding I will give." So if you are having a debtor of 90 days of a crore, then I'll give you 80% of 90 days as maybe 80 lakhs to you as a cash credit. So that probably we can ask for from the bankers to help the business owners to get more, because many of the businesses have got this differential debtors ka payment. Like some of the like the industries which I have been gone through is that shipping industry, where the money when you are shipping the goods and where they have these various timelines which it takes. Probably manufacturing of those will take more than 180 days for you to collect the money. The ships may not be sold at a time where you will be able to collect the money in 180 days. And most of the businesses where it is involving the government organizations, then there also you have delayed receipts, because they have a lot of requirements. Ke baba aapne project, you have done the project, so they will have somebody inspected, and the inspections will take more than 3 months of time, and then they have departments to approve the payment, and then you get the money after 6 months of delay, even if you have fulfilled the milestones. So such kind of businesses, when you are looking at cash credits from the banks, they have to put forth their problems and see to it that they get funded for 180 days of their debtors and not for 90 days. So such kind of action points is what we have to take, and it all will depend upon each individual business to business. what is the lead time from the product being raw material to manufacturing, what is the timelines required for them to manufacture, and from the manufacturing to selling, what is the timelines, how much time is you taking to sell those goods, and how much time from selling to collecting the money. So these are different buckets of time which is getting involved in the business, and you need to really understand whether that timelines, how am I going to manage the money and the cost. So if I know that if a product is going to be manufactured from right from the raw material stage to the sale stage and then to the collection stage, what is the time gap I'm looking at? मेरा जो cycle घूमेगा वो what is the timelines? Is it 6 months? Is it 8 months? Or is it 12 months? If it is 12 months, then how do I manage the entire cash in the organization for 1 year? That is 12 months. How do I manage it? Because once I get the raw material till it is being converted into cash again, the cycle is taking 12 months. So how am I going to manage the money? Is there a funds which is available? Am I investing myself personally, or is it that I ask the bank to invest in that entire process? So all this is to be looked into by the business owner, and that's where I think it will make more sense for them to manage their cash flow.
Now, ma'am, we've received a question from one of our attendees, and he's asking if there are any tools or reports that MSME founders should look at on a weekly or a monthly basis to stay cash aware.
Okay, so there are quite a few reports which I think I told you that we need to have a clear-cut budget, which I'm creating in the beginning of the month or probably the last week of the last month. So I have a budget, or annual budget to hona hi chahiye. Every month probably I can tweak it to make it a little more realistic. So annual budget is required for expenses, for revenue, all that has to be put on paper and it has to be done. And even in the annual, I would also go one step ahead and say, I need to have a 5-year business plan. I need to have my business plan which says that in the next 5 years, what am I going to do? How am I going to source those clients? And all that has to be chalked out in black and white for us. A blueprint is to be created. Every month I will review the budget and see what went right and what went wrong. So there has to be a review of the budget which needs to be done. That report has to be seen. Third is also going to be seen from the revenue perspective, a review of what is the business plan you did and what is your actual achievement. What is there in the pipeline, so that I know that, okay, this can be taken up in the next month. What is my pipeline? What is the action points which the sales team has to do? So there has to be a monthly review of the sales as well. So that is the second part, which I think as a report has to be done. And the third important part is, what is my collection history? What is the number of days in which I'm collecting? What is the number of days which I'm paying my vendors? So that cash flow evaluation is also required. So he has to review the cash flow statement every month as well. So these are the three, probably the most important aspects which a business owner has to sit down and read month ke beginning mein, and give a clear instructions to their subordinates who are taking care of these areas. Like cash flow has to be from the finance field, and probably sales team has to take care of the revenue generation. And if I am going to have a manufacturing facility, then my production team to tell me that where the budget went wrong for expenses and how I have increased. Like there might be a case that where my raw material prices went up very sharply because of some issue in the market, like there is a shortage of the material. So my budget says X rupees and I have spent Y rupees. So I have spent more. So each of the person who is taking care of it has to own and give that responsibility, and they have to give the answers as to whatever it is. So if there is a factor which is not controllable, I can't do anything about it. But if there is a factor which is controllable, I need to take actions on it. So that is the reason why these reviews will help him to take the corrective action, and so that the next month the same thing is not repeated.
Now, ma'am, tell us what are the biggest mistakes in vendor payment planning that strain liquidity?
Okay, so here the payment plan is as a very important aspect, like where I go on a lot on my instincts rather than the practicality. Like I might say that out of 10 vendors, okay, so I liked Amruta very well. I said Amruta and me has got a very close connection, and I release her payment even before 30 days. But I have a critical vendor who is sitting there and he is not being paid because I don't like him much. So that kind of the payment thing has to be based on the practicality. What material is very critical for my manufacturing? What is suppose, like for example, I am delaying the labor payment. What is the impact which is it going to give to me? It's going to be a huge impact. So I need to know that as far as the salary payment. I don't know whether you guys would have seen. I've heard Vinita, the of Sugar Cosmetics, saying that every month, the last week of the month, we are really jittery and anxious to collect the money so that I can pay the salary on the 5th of the next month. So if I'm not going to do that, I will not have a proper structure in place, and my manufacturing will go haywire. My employees will not behave properly. So I need to have funds for making my employee payment. I cannot delay that. I really don't have an option. But so I know I need to have a proper plan so that I have the money in the bank by 30th, so that by 5th I can make the payment to them as a salary. So that is very important. You need to know which are the critical payments to be done for your business. So like for example, I cannot delay salary. I cannot delay electricity bill payment. I cannot delay my probably an EMI payment, because once I delay an EMI payment, that means 2 EMIs bounced, I become an NPA. So I don't want all those kind of repercussions which is coming. So I need to prioritize my payments and make a list. So rank number 1, employee salary. Rank number 2, electricity bill payment. Rank number 3. So I need to rank them based on the criticality of those payments for my business, and accordingly use the cash wisely. Whatever cash I have. And the best part is, I mean, I don't know whether one of my clients used to say this, and this was a very important lesson which I learned. We as Indians, we always think about, to manage money, we would like to save money. But a growth mindset or a progressive thinking says that how do I increase my revenue so that I don't have an issue at all in my money? So I always think from that perspective, how can I increase my revenue so that with the given situation that I've got good amount of stuff, how do I monetize them and get more revenue so that मेरे को ये cash flow वाला issue ही नहीं है. It just vanishes away because I have tried to increase my revenue in the current month, and that is the reason why I don't have a cash flow crunch. So that's probably a growth mindset which people will have to do. But having said that, given the time that you have a limited cash flow, you need to prioritize your payments which are critical for your business. And that time, I don't think my personal expenditure comes anywhere near to the cash. It is the business which needs to sustain when the cash flows are limited.
Now, ma'am, tell us, when should a business owner consider taking external finance, for example, ODs or working capital loans, and when should they completely avoid it?
So, the main place where people commit the mistakes is that the first thing is identify where they need to take the money. The first part is, I would like to say that where there is a working capital gap. I told you, right? The total receipts of the collection from my debtors and what is the vendor's payment. If there is a gap in that, like I am able to source 100, but my liability to pay to my vendors for my employees and all that put together is 110. That means the gap is 10. So I need to take a support from finance for that 10. So understood that a gap hai, I need to get some funding. Now, once I've understood that the gap is there, how do I fund it also very important. I cannot take a term loan to fund that 10. I cannot take a unsecured loan to fund that 10. I should be only taking a cash credit where it can fund me that 10, and I need to have the rolling also so that the gap doesn't exceed 10, it remains at 10. So if I have decided the gap is 10, That means I need to stick to my process, which I have already installed, and see to it that this 10 doesn't become 20 and this 10 doesn't become 50. So the moment these kind of gaps keeps on increasing, that is where my existing cash credit is unable to take care of my cash flows. Now, if the gap is increasing, now there is a lot of possibility why the gap is increasing. If the gap is increasing, there might be something happening in the revenue side that I'm unable to collect the money. So if that is the case, increase the gap and take a better gap. So you give a contingency and take 50 from the bank, because the bank is not going to, every month it is not going to change it. Now, but if I've said take 50, doesn't mean that कि उसी महीने में मैंने 10 का excess 40 कहीं और invest कर दिया. I should not take out that money and put it somewhere where the money cannot get rolled. That is where the issue is. Like when I have a requirement of 10, I have taken 50. But what I do as a business owner, वो 40 लेके मैंने गाड़ी खरीद लिया. Or I put it an investment in my flat. Now, unfortunately, that 40 is not able to roll. I still have 10. Now given that 10, the gap starts increasing, and that's where I don't know what to do. So if I've taken, so take a decision which is conscious. Ki 50 which I've taken is for my business. So I will not use anything which will be beyond the business. It has to get rolled in that cycle only. And I have to be mindful about what is my collection, what is my payments. I need to keep on reviewing it. Rather, if you are as a business owner where there is a ICU status, on a daily basis, I need to review this. If the status is ICU, if it is a healthy thing, then at least 15 days or maybe 1 month time, I can review it. But if it's an ICU, I need to review it on a daily basis so that I know what is the gap and how I can fulfill the gap by taking loans from banks. So these are certain places where business owners, and honestly speaking, people think that doing business means they understand money. It's not like that. They don't understand money. There is the working capital cycle to understand. It takes its own time for themselves to understand. Like, for example, if I am a financial consultant and I would say, okay, tomorrow I understand your business and I will be able to give you a fantastic working capital cycle, then I'm a fool to say this. Because as a business, there might be a lot of challenges which probably are seen, which is unseen, intangible, which I as a consultant may not be able to see. I might be able to perceive to a certain level, but not necessarily every time I might be right. So there is always a continuous evolvement in this process, and I need to understand, learn, and take action. As a business owner, I also can't say that I have learned everything now, everything is going to happen on its own. No, I need to keep on learning. There might be a lot of challenges which may come, which I could not perceive it before, but now it has come. So I have to constantly keep on evolving as far as managing my money is concerned.
Now, ma'am, repeatedly we've received a question, that we've tried to tackle in multiple ways, and we would like to ask you also the same question. How can delayed customer payments be tackled, especially in industries where we have 60 to 90 days cycles, and these are the norms?
60 to 90 days is considered very normal. But once that 90 days ke upar par it goes, that's where the jittery starts, because 90 days, I think we really, rather the entire customer base or the business base understands that 90 days is something which is very normal. Okay. But now if you have a problem that in that 90 days, then you really have to understand. Now more, if you see some of the businesses, like let me put it to you, like a restaurant or somebody who's selling something from a shop or from an online portal. So 80 to 90 days is not there in their cases. Now in cases where we as a business owner are supplying some products to some corporates, that's where the 90 days seems to get crossed, because they are taking their own sweet time to give and then inspection. So when we are actually only being tortured, rather bullied by the senior corporates, like big corporates, by the smaller business owners, and when they are bullied by them, that is where the issue starts. Okay. So if that is the case, then what I rather give an advice is that have these government entities or probably big conglomerates as your business customers to an extent. Have some vendors who are in a position to make that payment to you a little faster. So have your basket of customers, having all of them as a part of it. Don't go only focus on government customers. And if you're really doing that, get a credit facility or credit line facility which gives you 180 days as your debtors to fund. So either do that or have a basket of customers where some customers are paying on regularly, some customers are corporate, so they have 180 days, 90 days ka credit, and have a robust mechanism for collection. Invest a lot of money in there, because put an employee who can do that. See to it that there is a CRM software which is invested in that you send mails, you send calls to them. So all that investment will probably help you to restrict the number of days to less than 60 and probably keep it up to 90. So that is where the thing is. So it's a jugglery kind of a thing. Now, if many of the organizations, if you want to scale up, then you have this challenge of not collecting the money. And if you really want to remain a small fish in the big pond, then you might be getting your money, but then you may not be in a position to reach that level. So it is always a game of where do you want to be and how much investment you need to do for such kind of jugglery. So that'll all depend upon the mindset of the business owner. And even if you're really having that clear mindset of doing collections and doing a lot of time in that, there still is chances of getting bad debts. So yeah, so you have to really keep on working on it so that you are able to manage the money also.
Now, ma'am, also help our attendees understand what should owners prioritize when there is a conflict between investing for growth and protecting cash reserves.
Okay, a very important question actually. So when I'm looking for investing in the growth, okay, so obviously I need to sit into my drawing table and find out that if I'm investing, so I really have to have a very clear-cut goal that I am investing so much, what is the ROI which is coming out? Though I might not be very crystal clear as to how much it is, but I really need to have some plan in action which says that, okay, I'm going to invest 100. So my expectation is that in the next 2 years, I will get this much revenue or this much return on investment which will come. So I really need to understand, sit on the drawing board, and probably here I might look for a consultant who can help me. And if I don't want the consultant, then it will be a trial and error. I might put the money, but I might not get the return on investment. So I might have to change the direction. So where investment is a loss. Okay, I lost that money. So I need to have that kind of a reserve to shell out in my trial and error. Okay, but if I'm really having a very limited cash, then I need to sit with a consultant who can help me to analyze what is going to be the ROI. So am I going to make a marketing plan? Am I going to acquire a new business? Am I going to increase my sales by doing maybe some discount drive? There might be a lot of action points which I might take for my growth. So I have to have a consultant who can help me to tell me that whether this investment is going to fetch the ROI which I'm looking for. So I need to do that. Now, cash reserves. Now, this is something which, as I told you, in the Indian mindset, we want to have reserves in us rather than investing and incurring a lot of cost. Now, let me take an example for myself only. So I have now enrolled into a course where it is asking me to pay a 1 lakh rupees fees for it. I don't know whether the revenue is going to come or not. I have a plan. I don't deny that. I have a plan that I'm going to connect with so and so. I'm going to do this. I've already had one level of talking with them. The business might go through. I don't know. As of now, I don't know, but I've already invested that money in myself to learn some new techniques. So I have to see that this is as an investment, and obviously I'm going to try. Suppose if it doesn't happen, if I don't have the greater revenue which is achieved. So here I probably may not be able to do a mathematics here, but then yes, obviously there will be a time when that revenue would come for me. So I really need to take that leap of faith with probably a proper analysis, but the leap of faith is required to be taken when I invest in the future growth. So vis-a-vis to the reserves, then I can probably take a 50% for growth and then 50% for reserves, and or if I'm a little aggressive, then 30 and 70 can be done. 70% I can look for the growth actually.
Now, ma'am, in your opinion, how does a founder's mindset impact financial decision making during cash stress?
The founder's mindset is really probably not driven by practicality, than it is driven by instincts. Okay, so most of the times instincts may be correct as far as business decisions is concerned, but as far as the cash decisions are concerned, you need to work on data. So I always prefer business owners working on data rather than working on instincts. But having said that, most of the business owners do have, when the instincts would work specifically when you're taking some leap of faith on revenue, or probably for acquiring some company, probably taking a marketing route which we are thinking of doing it. So those things can be done on instincts, but certain decisions will have to be based on data, which is going to impact your cash flows. So that is why I said that business owners do require a mentor who would probably say something which any of their organizational juniors may not say, because obviously every business owner likes an yes man. I mean, they would like to listen to rather a validation from all the employees who say that मैंने जो सोचा है वो सही सोचा है. So that is what I expect, but I don't expect any conflict from the employees. They don't expect the current employee to say no, this is not working, can we do it in another way. So that is not expected out of them, but unfortunately that will bring growth. Now, a classic example is of the Pixar company, which actually was taken over by Disney. But the way the team of Pixar was working, it was really amazing, and Disney found it to be the best way to grow. So they adapted it, and every employee in that company used to start sharing their opinions and their views, and collectively they used to take decisions. And that is how it helped the business to grow. So we have to understand that employees sometimes may give you some valid pointers which needs to be taken up. Just because he's an employee, you cannot reject it. You need to take it up. So so the founder's mindset needs a lot of change. Don't do a business just for the time's sake. It is a business, so it really needs. It has got its own challenges and positives. So really be mindful about it and take decisions which are based on data and not purely on instincts, especially when it comes to cash.
Also, ma'am, can you help our attendees understand what framework helps determine whether a business is truly ready to scale financially?
So yes, there is a framework. There is a review which you can do of your business where it really now decides that it needs to scale up. One is your customer base is not increasing. Like you have 15 customers and every time you're trying a lot to get more, but 15-20 se zyada बढ़ नहीं रहा है. So essentially a time frame where you really need to know how to scale it up, make the 20 into 50 or 100. How am I going to reach there? That's number one. Second is that there is a lot of a buzz around that your products are not to the mark, or probably you are not in a position to get the customers liking your product. So there is some gap in that. So that is another time where you really need to find out why are you here and how you can scale it up. And third thing is very important is that the morale of your employees is all going down. Okay, अरे यार हम कितना भी try कर रहे हैं 20 से ऊपर नहीं जा रहा है. There is something which is not working. I'm not in a position. I'm not happy. So if you see a lot of iteration happening in your business, you know that for sure that there is something going wrong in the business and you need to scale it up. So I think these are certain signals which I understand, and there is no template as such. But if you have these kind of signals which is coming into your business, then you really need to sit onto your drawing board and start thinking, how do I increase my sales? I should not get complacent with the 20 which is there. I'm not. Every time it happens that the employees do not have all the time have the energy to keep functioning the same way. They also need some changes. They also need some motivation to go to their work. So all that is what is a signal which says that I need to scale up.
Ma'am, according to you, what are 3 non-negotiable practices that every MSME should adopt to stay cash stable even during economic slowdowns?
Non-negotiable is one, I told you, a very, very clear-cut personal expenses not to be considered from business. So such a non-negotiable thing. Okay, that's number one. And the second thing is that you really have to work on your cash flow gaps, like your working capital gaps. You need to work on it. And in case you have done any sources of finances from the companies, then from the bankers, then you need to be very mindful as to how we are using that money. So that's a non-negotiable, because it's a two-way sword. In one case, you make a mistake and you're really not able to pay the EMIs, then you really will be out of the business very soon. So you really have to be mindful about how you're using the money of bankers. So you need to be very sure about it. And the third thing, what I would say is that as a business owner, you really need to have a plan and review mechanism. If you really are not having this mechanism, then there might be a time when you might have no businesses and you will be probably grounded. So I don't want that to happen to any business. So a review and budget and review mechanism needs to be there. Personal finances not to be used for companies. And the third thing is be mindful of the cash flow gap. That is a working capital gap, which I am wanting to finance it.
And my last question to you is, what role do CFOs or external financial advisors play in building cash smart businesses?
Yes. So I think CFO is very important, because I think as a small business owner, I think I am the CFO. The business owner himself thinks that he is the CFO. But no. But what happens is that most of the business owners have a sales mindset. They are a part of their sales and they are technically knowledgeable. They know the product. They know how to capture the market. But unfortunately, finance is not what they know. They think they know, but then unfortunately they don't know. And they might learn it. Probably, yes, they might learn it. They might learn it by burning their hands first. So instead of burning their hands, if they have a virtual CFO or a CFO who can support them through their journey, nothing like it. It's an investment which they would be doing on an important person in the business, which is the money manager, who is going to manage your money. And that is where it is going to be a game changer for business owners, because most of the time it happens that business owners do not have somebody to support. And as I told you, somebody who can ask the right kind of questions and probably get answers from them makes a lot of sense to the businesses, rather than committing that mistake and then learning it on themselves. So that is the expense which they will be doing. So instead, invest in this person. So this person can be of a great help to you and probably can generate a lot of more revenue for you, instead of you spending that money on committing your mistakes. So a CFO is very, very important. And I've been taking a lot of sharing a lot of tips that how CFOs help. They help you to prepare budgets, they help you to review it, they help you to take decisions on what kind of financing you need to do, how you can raise money, how you can use the money wisely. A lot of things they will be supporting. And that's where the businesses can stand tall and actually think of scaling up rather than taking care of those routine things, which these people will be in a position to take care of. Yeah.
Ma'am, with that, we've come to the end of today's episode. Thank you so much for joining us again this time and for sharing your detailed insights on, why profits are not just enough and why MSMEs need to fix their cash flows. Thank you so much for joining us, ma'am.
Thank you so much. Thank you so much, Amrita. It was wonderful talking to you. And I surely hope that whoever is going to see this episode would seriously take their cash flows more seriously rather than looking at their profits. Thank you.
They will definitely do that, ma'am. Thank you so much for joining us. For our attendees who are online, if you'd like to view the current episode, if you missed any part of the current episode, please go on YouTube, type GSW1 MSME, and you'll find all the episodes included there. Thank you once again, ma'am. Bye-bye.
Thank you. Bye-bye.